pushes through. But the idea is, of course, that if we're looking at it from a dealer's key point of view, that if this was a dealer's key here and this was a dealer's key here and this dealer's key here goes offered, the idea is, of course, that this becomes the mid price and this becomes the bid. So the idea is that we'll maybe trade from here to here and it'll go backwards and forwards between these 2 points. And what's going to happen a lot of times is that the price ends up jamming in this area here for a while. And then because of that, this is now going to go bid here. So the price is then going to go bid into this area here. So this is now the actual commercial offer. This is now the commercial bid. And what the dealers are trying to do is figure out whether anybody goes bid or offered at this price. Because they will go bid here and they will go offered here, right? They will always go bid and offered in these areas as a starting point because they're 2 prices away from the level. So what's going to happen is they're going to come back up into this area here and they're going to do the same. They're going to try and see whether there's... So in other words, the first one we hit from a bid or the first one we hit from an offer is the one that the dealers have the biggest problem with, because they're going to wait to see, does anybody sell this? Does anybody buy this? What are they doing in here? Because on these 3 candles, when it sold off of this price, they bought off of this price. When it bought off of this price, they sold off of this price. When it sold off of this price, they bought off of this price. But then the seller dropped down. And all of a sudden, the dealers are then saying, right, we're pulling, and the dealer pulls to this one. Well, if you look at your dealer's keys, and they're not far removed from what they were yesterday, of course. So that's why it's perfectly valid to keep looking at them today. You'll notice that when the selling came in from this level, they bought off of this level. They sold off of this level. They didn't buy off of this level, which means this becomes fair value, probably sell side value above. So the buy trade is now going to be at this price. So if you just look at the 3 buy trades, you can see that from a lower price, it goes from there to there and from there to there, right? So that's the 3 buy trades there. So obviously, if that's the case, the definite sell isn't this price. The definite sell is going to be this price. Definite sell, right? So we know with 100% certainty that the trade is going to be short sold here, and it might never develop from it, but it's going to be short sold from here. So we get that idea that when we move through these definite price levels, we know where the next bid is going to be, based on where the offer came in from. So if the offer came in from here, I can't guarantee there's going to be a bid here, but I can guarantee there's going to be a bid here. If I get a buyer here, I can't guarantee there's going to be an offer here, but I can guarantee there's going to be an offer here. You know what I mean? It's just the way it works. And when you think about it, it kind of makes sense because, obviously if there was a sell here and the dealers got short, then of course they might start neutralizing portfolios here and going bid on this phase. And then they'll go neutral here and go offered on this phase. They'll go offered here, go neutral on this phase, and then they'll go bid here, right? So they'll go neutral here, bid here, neutral here. They'll go offered here. And this, if you go back to the quant interview, and I mentioned this morning with the guys in the room this morning in London. If you go back to that quant interview, that makes sense, doesn't it? Because they never go bid and they never go offered. They're always at stages of. They're always inside of stages of bids and offers, aren't they? So they never actually go, this is it, this is my buy trade. They're in it or they're not in it. That's the basic idea. We're going to touch on that this afternoon because it's you can see some interesting trade ideas coming from that with regard to interesting trade levels. And you can see when the market maker, for example, maybe goes sell side at a lower price or whatever. And at the moment, on the NASDAQ, the market maker went sell side at a lower price at 640. So obviously we can recognize with the market maker going sell side on the NASDAQ at 640, you could have taken a short at 640. So if everybody saw that, you could have taken your short sell at 640. Well, that's what I did. And I made myself a very quick profit of $400 literally within 3 or 4 minutes. Now, obviously, I've been watching that little tap back down into the bottom edges there and I've managed to book some money. But I now have a key level that I'm going to be working against as a seller. So I hadn't taken any shorts. I was looking for a short. I was looking for a way into the short. I got my way into the short and I'm making some money on the short now. So again, you can look at it. So let's just touch on this. We will come back to it in Classroom, guys, so that you can get it recorded. But you can see the short comes in here. See the change over here into a short sell. So when that changed over into a short sell at that point, I then sold into that changeover at 640. And then when it started to squeeze the gap here, I started to close out my positions into the bottom edge at 625s. Great trade. Great trade. Jerry, you can't start saying stuff like that, because what's going to happen is he's going to start putting these prices up again, isn't he? And none of us will be able to afford any of his products.